Welcome back. The late 1970s, it was a pretty grim time for the American economy. We're talking inflation soaring at 20%, unemployment just climbing and climbing, and that infamous energy crisis where people were quite literally waiting in line for hours just to get a tank of gas. It genuinely felt like the great engine of American prosperity had just stalled out. But then, enter Ronald Reagan. He brought this radically new rescue plan to the political stage. So today, we're going to break down the massive impact Reagan's policies had on the economy. We'll be exploring two very different realities of that era, really comparing the unprecedented sky-high successes of major corporations with the much harsher realities faced by the everyday working class. Okay, let's dive into this. Here's our roadmap for today. First, the promise of Reaganomics. Then, taxes and deregulation. After that, we'll look at the successes of corporations, followed by the situation of the working class, and finally, the economic divide.
All right, let's kick things off with part one, the promise of Reaganomics.
Now, to really understand the 1980s, you absolutely have to understand Ronald Reagan's core philosophy. His first inaugural address delivered what became the defining motto of a brand new era. He said, "Government is not the solution to our problem. Government is the problem." You see, ever since FDR's New Deal, Americans had heavily relied on the federal government to step in and solve economic issues. But Reagan proposed a massive, fundamental shift. He believed that heavy welfare spending and income redistribution were actually suffocating the economy. His proposed solution? Just get the state completely out of the way of business.
At the very heart of this new approach was something called supply-side economics. And the idea here is elegantly simple. The theory goes that if you drastically cut taxes for corporations and wealthy individuals, they aren't just going to hide that extra cash under a mattress, right? Instead, they'll invest it into new businesses, expand their production, and hire a bunch more people. Proponents of this theory promise that the wealth generated way up at the top would eventually trickle down to the working class through higher wages and an abundance of new jobs. Moving right along to part two, taxes and deregulation. The new administration absolutely did not waste any time turning this economic theory into federal law. Let's move to and see how this builds. By July of 1981, Congress passed a truly historic $675 billion tax cut. The top marginal income tax rate plummeted from 70% all the way down to 50%, and the capital gains tax was totally slashed from 28% to 20%. And right alongside that, they pushed forward with rapid, massive deregulation. This was especially true in the airline and trucking industries, completely lifting restrictions to just fuel the markets.
But, deregulation wasn't just about changing business rules. It hit the labor market incredibly hard, too. A pivotal turning point happened in August of 1981 during the PATCO strike. That's the Professional Air Traffic Controllers Organization. Even though this union had actually supported Reagan's campaign, the president took a notoriously hard line. He ordered the striking union members back to work, and when over 11,000 of them refused, well, he simply fired them all. This left the American labor movement absolutely reeling and sent a very clear message. The economic terrain had shifted decisively in favor of employers over organized labor.
And this brilliantly illustrates that severe loss of bargaining power. By the end of the 1980s, the unionized portion of the private sector workforce had plummeted from 20% down to just 12%. The working class was essentially losing its leverage at the exact same time the broader economy was gearing up for this massive period of growth.
That brings us to part three, the successes of corporations.
And let me tell you, that corporate growth definitely happened. Following a pretty severe recession in the early 80s, the macroeconomic indicators were just staggering. The stock market went absolutely into the stratosphere. To put it in perspective, the Dow Jones Industrial Average was sitting at a modest 950 points in 1981, but it peaked at 2,239 by the end of Reagan's second term. That is a massive jump. Inflation was successfully tamed down to about 3.5%, and by 1984, real disposable income had grown by a really impressive 5.8%. For investors in big business, it truly felt like morning in America. Now, what's really interesting about this slide is how that boom completely transformed executive compensation. If we look at constant dollars, the annual pay for an average CEO shot up from around $3 million in 1980 to a whopping $12 million by 1988. I mean, think about that. In under a single decade, top-tier executive pay quadrupled. Wealth at the very top was concentrating at speeds we had rarely ever seen.
At the same time, the financial industry was finding aggressive new ways to extract profits. Wall Street was busy minting brand new stars, folks like Michael Milken, who became famously known as the junk bond king. Brokers were reaping absolute fortunes by selling these high-risk, high-yield securities, which in turn triggered this relentless frenzy of corporate takeovers and stock market speculation. The party just seemed endless. But remember that whole trickle-down theory we talked about earlier? We have to ask, did all that wealth actually reach everyone else? Well, let's switch gears and look at part 4, the situation of the working class. Herein lies the main contradiction, the real tension of this entire era. Yes, it is absolutely true that the 1980s economy ultimately created more jobs than it lost. But you really have to look at the trade-off here. Half of all the jobs eliminated during that decade were in stable, high-paying industrial sectors. Meanwhile, on the flip side, half of all the new jobs being created didn't even pay wages above the poverty line. The country was essentially trading away its well-paying manufacturing base for a surge in low-wage work. For everyday blue-collar Americans, the decade actually delivered a brutal sequence of economic hits. In the early 80s, intense foreign competition completely shuttered steel and auto factories all across the Rust Belt. Then, by the mid-80s, you had skyrocketing interest rates that sparked a massive farm-in crisis, leading to just a devastating wave of farm foreclosures. And if that wasn't enough, by the late 80s, rampant deregulation triggered the savings and loan crisis, which tragically wiped out the precious life savings of countless ordinary Americans. This deep pain of deindustrialization didn't just stay in the economics textbooks, it bled right into the culture of the time. Bruce Springsteen perfectly captured the voice of this blue-collar struggle in his song, My Hometown. The lyrics go, "My foreman says these jobs are going, boys, and they ain't coming back." Deindustrialization wasn't just some abstract concept. It was a harsh, tangible reality for millions of families who were quite literally watching their entire way of life disappear. Which brings us to our final section, part 5, the economic divide. This final tally perfectly captures the massive paradox of the 1980s economy. On one side of the ledger, you have these undeniable, booming macroeconomic victories. Overall unemployment dropped down to a healthy 5%, the Dow was breaking records at 2,239, and you could buy a gallon of gas for under $1. But the human cost accompanying that growth was staggering. Between 1985 and 1989, 33 million Americans were stuck living below the poverty line. The poverty rate for Black Americans sat at a massive 31.6%, and ordinary taxpayers were eventually left holding a $132 billion bill just to bail out those collapsed savings and loan banks. The size of the economy grew, absolutely, but the gap between the rich and the poor was permanently widened. So the crucial point is this final, somewhat unexpected outcome. Despite all those conservative promises to shrink the government and balance the budget, the national debt actually went into orbit. When you slash tax revenues while simultaneously greenlighting over $1 trillion in military spending, the math catches up with you. The national debt skyrocketed from $914 billion in 1980 to an incredible $2.7 trillion by the end of the decade. Fiscal discipline essentially took a backseat to massive deficit spending. Ultimately, Reaganomics fundamentally altered the entire language of American politics. It restored the country's swagger, it triggered an unbelievable corporate boom, and it really laid the groundwork for our modern financial markets. But, as we've seen, the price of that immense growth was distributed very unequally. Social safety nets shrank, organized labor was crippled, and severe wealth inequality basically became the new normal. So, looking back at the transformative, highly polarizing legacy of the 1980s, I want to leave you with this one thought to ponder. When the economic tide finally rose, did it lift all boats? Or just the yachts? Thanks so much for joining us for this explainer, and we'll catch you next time.